How does Murabaha work for trade finance? Imagine needing to buy raw materials for your business but wanting to stay within Islamic finance rules. You might wonder how you can do that without paying interest. That's where Murabaha comes into play. Murabaha is a type of Islamic trade finance contract based on a sale with a profit margin, not interest. It starts when a customer asks a bank to buy specific goods for their trade or business. The bank then purchases these goods from a supplier, taking ownership and responsibility for delivery and quality. This means the bank assumes risks like ensuring the goods are defect-free and arrive on time. Once the bank owns the goods, it sells them to the customer at a price that includes a pre-agreed profit margin. This profit is fixed upfront, so both parties know exactly how much will be paid. The customer then agrees to pay this price over a set period, which can be in full or through installments. The payment schedule depends on the business's cash flow needs. Unlike a traditional loan, the bank is not lending money with interest. Instead, it is selling the goods at a marked-up price. This makes the transaction compliant with Islamic law, which prohibits interest. The profit margin is transparent and agreed upon before the sale, making the process clear and fair. In trade finance, Murabaha is often used to fund the purchase of raw materials, machinery, or finished goods. The financing period usually matches the time needed for the goods to generate revenue or be sold. For example, short-term trade might be financed for 90 to 180 days, while capital equipment could be financed for several years. A key point is that the bank must take actual possession of the goods before selling them to the customer. This ensures it is a real sale, not a disguised loan. The profit margin remains fixed, so even if the customer delays payments, the profit does not change. If late payments occur, penalties are usually handled in a way that does not benefit the bank, often by donating to charity. Ownership of the goods only transfers to the customer after full payment, protecting the bank's interests. This process provides a Sharia-compliant alternative to interest-based financing, helping businesses grow while following Islamic principles. In summary, Murabaha in trade finance works as a structured sale where the bank buys goods on behalf of the customer and sells them at a marked-up price, allowing deferred payments. It offers a transparent, ethical way for businesses to access the goods they need without violating Islamic laws.